All right, stop scrolling for a second, because something just snapped in silver and it matters right now. In less than a week, Western silver prices collapsed almost 30%, from roughly $121 an ounce down to the mid-80s. That's not a typo. Tens of billions in paper value vanished in days. But here's the part people are missing. At the exact same time, Shanghai silver barely flinched, holding near 122. That's a 40+% physical premium over Western prices. Both Western futures data and Shanghai exchange pricing just confirmed it, and those two almost never diverge like this unless the system is under stress. Stay with me, because I'm going to show you why this wasn't a demand crash, what to watch as this week opens, and how you can recognize this pattern the next time it shows up before the headlines catch on. If you're holding silver right now, if you're watching this market, or if you're just trying to understand what the hell is happening, you're ahead of most people. Your job is to understand the mechanics, not just react to the price. Before I explain what caused this, let me teach you something most people don't understand about silver. Silver doesn't trade like gold. It trades like leverage with a personality disorder. It's thin, it's volatile, and when it runs on borrowed money. Think of silver like a crowded theater with a single exit. Everything feels fine while prices rise. People are buying, momentum is building, everyone's making money. But once someone yells margin call, everyone tries to leave at once. And that's why silver crashes feel violent and fast, not slow and logical. When you see speed plus magnitude compressed into days, you're usually not watching fundamentals change. You're watching positioning unwind. And that distinction matters because if you confuse forced selling with real selling, you'll always react late. You'll think the story changed when really it's just the structure breaking. So what does that tell us? It tells us that silver's price action is often more about who owns it and how they own it than about supply and demand in any given moment. When hedge funds pile in with leverage, when momentum traders chase upside with margin, when speculators build huge positions financed with borrowed money, you're not just looking at a bet on silver's value. You're looking at a time bomb of forced liquidation risk. And the moment market conditions shift, the moment volatility expands or prices drop enough to trigger margin requirements, all that leverage has to unwind. It doesn't matter if the people holding those positions still believe in silver long term. It doesn't matter if physical demand is still strong. They have to sell because the math says so. That's the mechanical nature of leverage-driven markets. The selling isn't emotional, it's mathematical. Now here's what's actually happening. Let me break down the sequence so you can see the cause and effect chain. Silver went parabolic first. Western paper prices ran far beyond what physical flows could justify. You had prices climbing through 100, then 110, then 120. And that move attracted attention. It attracted leverage. Hedge funds saw momentum. Momentum traders saw a trend. Retail investors saw gains and piled in. Everyone was chasing upside with margin because why use your own money when you can control more silver with less capital, right? That's how parabolic moves work. They feed on themselves until they don't. Then volatility expanded. And here's where the mechanics get really important. When volatility expands, exchanges and brokers look at the risk in the market and they raise margin requirements. They say, hey, this market is moving too fast. We need more collateral to cover potential losses. So if you were controlling $1 million worth of silver with $100,000 in margin, suddenly they tell you that you need $150,000. And if you don't have that extra $50,000 sitting in cash, you have to sell. Not because you want to, not because you think silver's going down long term, but because you're forced. That's the first wave. When that first wave hits, prices drop. Maybe silver falls from 120 to 110 in a day. That drop triggers more margin calls on other positions. More people get forced to sell. More selling hits the market. And this is where liquidity starts to disappear. See, in normal markets, there are buyers and sellers on both sides. But in a forced liquidation event, everyone's trying to sell at the same time. And nobody wants to catch a falling knife. So liquidity disappears. Spreads widen. The difference between what someone's willing to pay and what someone's willing to sell for gets huge. And suddenly bids evaporate. You've got sellers desperate to get out and no buyers willing to step in at those levels. So prices have to fall further to find the next buyer. And that creates another wave of margin calls. And another. And another. Here's what's wild about this. None of that requires new supply to hit the market. None of that requires physical demand to fall. You could have the exact same supply and demand picture you had a week ago, but if enough leverage is in the system, the price can crash 30% just from the mechanics of forced selling. It's a self-reinforcing loop. Price drops cause margin calls. Margin calls cause selling. Selling causes price drops. Round and round until the leverage is flushed out, or someone steps in to provide liquidity. Now, at the same time this was happening in Western markets, physical buyers in Asia didn't blink. Shanghai silver held above 115, then 120, even as New York and London were collapsing. You had the Shanghai Futures Exchange showing prices near 122 while COMEX was trading in the mid-80s. That's your secondary confirmation that this wasn't about fundamentals. Physical buyers, the people who actually take delivery of silver, who use it in manufacturing or hold it in vaults, they didn't suddenly decide silver was worth 30% less. They kept buying. They kept holding. The physical market refused to follow the paper market down. And that brings us to the convergence proof. The spread itself tells the story. When paper collapses but physical refuses to follow, you're not watching silver get less valuable in some fundamental sense. You're watching the paper market purge leverage while the physical market reflects actual supply and demand. That 40% premium of Shanghai over Western prices? That's not normal. In a healthy market, those prices converge because of arbitrage. Traders buy cheap in one market and sell expensive in another until the prices align. But when you see a spread that wide persist for days, it means the normal arbitrage mechanisms are broken. It means the paper market is so distressed, so focused on liquidation, that it's temporarily disconnected from physical reality. But here's the part that should make you nervous. Once this kind of price discovery starts, nobody knows where the air pockets end. You don't know how much leverage is still in the system. You don't know who else is about to get a margin call. You don't know where the next layer of forced sellers is sitting. So even if you believe in silver long term, even if you think this is just a technical washout, you have to respect the fact that the downside could extend further before it's done. That's the nature of leverage-driven crashes. They overshoot. They go further than logic says they should because the selling isn't logical. It's mechanical. This is the exact same playbook we've seen before. Go back to 2008. Silver crashed over 50% during the liquidity panic as the entire financial system seized up. Everyone was selling everything to raise cash. Hedge funds were getting redemption requests. Banks were tightening credit. Margin calls were hitting every leveraged position in the market. And silver, being one of the more leveraged and volatile assets, got crushed. It went from around $20 down to under $9 in a matter of months. And at the time, people said silver was dead. They said the bull market was over. They said demand had collapsed. But what happened next? Silver doubled within 2 years. By 2010, it was back above 20. By 2011, it hit nearly 50. Because once the forced selling exhausted itself, once the leverage was flushed out, the fundamental drivers reasserted themselves. Look at 2011. Silver spiked to nearly $50 on a combination of monetary fear and speculative momentum. Then it collapsed brutally, falling back to the low 30s within weeks. Same pattern. Leverage built up, volatility expanded, margin calls hit, forced selling cascaded, and silver spent months retesting those lows, grinding through support levels, shaking out the weak hands before it eventually stabilized. The people who panicked at the bottom missed the entire next leg up. The people who understood the mechanics and waited for stabilization got rewarded. Or March 2020. That's probably the clearest example because it happened so fast. Silver was trading around $18 in February. Then COVID hit. Markets locked up. Liquidity vanished. And silver got smashed down to $12 in a matter of days during forced liquidation. Not because the world needed less silver. Not because demand collapsed. But because everyone needed cash and silver was one of the liquid assets they could sell. What happened next? Silver exploded higher. By August, it had hit nearly $30. That's more than doubling in 5 months after a brutal crash. Every time this happens, the sequence rhymes. You get a sharp leverage-driven crash first. Then you get confusing headlines. Analysts scramble to explain why silver fell. They talk about demand destruction or oversupply or changing fundamentals. But if you know what to look for, you can see it's just positioning unwinding. Then you get either a violent rebound once the selling exhausts, or you get a deeper washout if there's another wave of forced selling still coming. But when you zoom out, when you look at the larger story, you see that silver's biggest moves are almost never about supply and demand in the moment. They're about who's forced to sell today versus who can wait until tomorrow. They're about leverage and structure, not value and fundamentals. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this still go lower? Absolutely. If liquidation resumes, if there's another wave of margin calls, if more leverage needs to unwind, $70 to $75 becomes very real. And that's where the calls for $50 start sounding less crazy. I'm not predicting that, but I'm not ruling it out either. Markets in forced liquidation can overshoot by shocking amounts. So if you're thinking about buying here, if you're thinking this is the bottom, you need to be prepared for the possibility that it's not. Could there be manipulation? Sure. There are theories about big banks suppressing silver prices, about concentrated short positions, about all kinds of things. And look, I'm not here to tell you those theories are impossible. Markets aren't perfectly fair. There are big players with big positions and big influence. But here's the thing. It doesn't actually matter whether there's a villain behind the curtain or not. Arguing about conspiracy doesn't help you trade. It doesn't help you invest. The thing about conspiracy narratives is they distract you from what you can actually measure. You can't measure someone's intent. You can't prove manipulation in real time. But you can measure volatility. You can measure spreads between paper and physical. You can measure whether forced selling is fading or accelerating. Focus on what you can control. Focus on the data you can see. That's how you stay grounded when emotions are loud and theories are everywhere. There are probably three types of people watching this right now. The first type is the long-term silver believer. You've been stacking for years. You believe in the monetary case for silver, the industrial case, the supply deficit story. You've been waiting for a pullback to add to your position, and now you're seeing prices 30% lower, and you're wondering if this is your moment or if it's a trap. For you, here's what I'd say. Patience matters more than bravery right now. Yes, prices are lower. Yes, this might be a good entry point, long term. But if this is truly a leverage-driven crash that's still unwinding, trying to catch the falling knife can hurt. Let the market prove stabilization before you act. Wait for volatility to cool. Wait for prices to hold a level for more than a day or two. Wait for some sign that the forced selling is done. You've waited this long. Another week or two to see confirmation won't kill you, but buying into ongoing liquidation might hurt your conviction when prices drop another 10 or 15%. The second type is the short-term trader who's already bruised. Maybe you bought silver at 100 thinking it was going to 150. Maybe you held through the initial drop thinking it would bounce. And now you're down 20 or 30% and you're trying to decide whether to cut your losses or hold through the pain. For you, levels matter. If 80 to 85 doesn't hold, if prices break below that zone with volume and momentum, respect that signal. Don't marry your position. Don't fall in love with a trade that's not working. The market doesn't care about your entry price. It doesn't care about your conviction. It only cares about supply and demand, about buyers and sellers, about structure and flow. So set your line in the sand. Decide what price level would tell you this isn't just a dip, it's a breakdown. And if that level breaks, protect your capital. You can always re-enter later when the picture clears. The third type is brand new to this. You're just trying to understand what the hell is happening. You saw silver in the news, or you heard someone talking about it, and now you're watching this massive volatility, and you're confused. For you, the lesson is simple but powerful. Learn to separate structure from story. The story is what you read in headlines. Silver crashes on demand concerns. Silver falls on dollar strength. Silver drops as investors flee risk. Those are stories. They might be true, they might not be, but they're narrative explanations after the fact. Structure is what you can measure. Volatility levels, margin requirements, open interest in futures, spreads between paper and physical. Price action tells the truth before narratives do. If you learn to read structure, if you learn to watch positioning and leverage and mechanical forces, you'll understand markets faster and more accurately than if you just follow the stories. That principle applies to everyone watching, no matter your strategy, no matter your time frame. So here's what I want you to answer in the comments. Which type are you? Are you the long-term holder trying to decide when to add? Are you the trader trying to manage a position? Or are you brand new trying to learn? Let me know, because understanding your own perspective is the first step to making better decisions. Now here's where I stand. I'm not panicking, and I'm not chasing a bounce. I'm watching. Let me tell you what I'm personally watching as this week opens. First, I'm watching whether volatility cools. If implied volatility in silver options starts to compress, if the daily price swings start to narrow, that's a signal that the panic is fading. If volatility stays elevated or expands further, that tells me there's more pain coming. Volatility is the fear gauge. When it spikes, forced selling accelerates. When it cools, stabilization becomes possible. Second, I'm watching whether Western prices can hold that $80 to $85 zone without cascade selling. That's the level where we are right now. If prices stabilize here, if we see buying come in and support develop, that's encouraging. It means the sellers are exhausted, at least temporarily. But if we break below 80 with conviction, if we see another leg down with volume and momentum, then I have to respect the possibility that there's more leverage to flush. The market will tell me where the real support is. I don't have to predict it. I just have to listen. Third, I'm monitoring Shanghai in the physical market. If Shanghai stays above 115, if that premium persists, it confirms that physical demand is still there. It confirms that this crash was mechanical, not fundamental. The physical buyers aren't panicking, they're not dumping, they're holding or even adding. That's a positive sign for the longer-term picture. But if Shanghai starts to crack, if that premium narrows sharply, then I have to reassess, because that would suggest physical demand is weakening too, and that changes the equation. Based on my analysis, this crash was structural and technical, not fundamental. The fundamental picture for silver hasn't changed in a week. The supply deficit is still there. Industrial demand is still growing. Monetary uncertainty is still present. Solar panel production still requires silver. Electronics still need silver. The green energy transition still needs silver. None of that disappeared. What changed was the positioning, the leverage, the structure of who owned silver and how they owned it. And when that structure breaks, when forced selling takes over, price disconnects from fundamentals temporarily. If history rhymes and silver follows the pattern we've seen in 2008, 2011, and 2020, the move that follows could be just as violent as the crash. I'm not predicting a specific target. I'm not telling you silver's going to 150 or 200, but I am telling you that when leverage-driven crashes resolve, when forced selling exhausts, when the weak hands are shaken out, the rebound can be fast and powerful. It can catch people off guard just like the crash did. So whether you're buying, selling, or watching, stay alert. The next chapter could be just as dramatic as this one. I'm not a financial advisor. This is not financial advice. I'm sharing my analysis, my framework, my way of watching these markets. But you have to do your own research. You have to make your own decisions based on your own situation, your own risk tolerance, your own time frame. Don't take anyone's word as gospel, including mine. If you made it this far, you're the kind of person who wants to understand, not just react. That mentality will serve you well. The people who survive these markets aren't the ones with the hottest tips or the best predictions. They're the ones who understand structure, who watch positioning, who separate mechanics from narratives. Keep building that skill set. If this analysis helped you see silver differently, if it gave you a framework to watch what happens next, share this with someone who needs to see it. Hit subscribe if you want more of this kind of breakdown. And stay ahead of the noise by thinking critically, verifying the data, and making your own decisions. Stay sharp out there.